Let me tell you a story that will sound familiar. You take your dog to the same local vet you've used for 10 years. The sign out front is the same, Smith Family Veterinary. Dr. Smith is still there, the receptionist is the same, but something feels different. The waiting room has been remodeled. There are fancy screens on the wall advertising wellness plans. And then you get the bill. A checkup that used to cost $80 is now $250. They added a medical waste fee. They added a facilities fee. They pushed you to buy a $500 blood panel for a healthy dog. You walk out confused. You think inflation is getting crazy. I am here to tell you, that wasn't inflation. That was a revenue optimization strategy. Dr. Smith doesn't own that clinic anymore. 6 months ago, he sold it to a massive conglomerate backed by a $50 billion private equity firm. They kept his name on the door to keep you comfortable, but they changed the operating system to bleed you dry. This is called a roll-up, and it is happening to your dentist, your dermatologist, your collision repair shop, and your plumber. Wall Street is running out of big companies to buy, so they are coming for Main Street. To understand why this is happening, you have to understand the math of private equity. It relies on a concept called multiple arbitrage. In the business world, companies are valued by a multiple of their profit. A small, local plumbing business with $1 million in profit usually sells for 3x or 4x earnings. It's risky, it's small, it's illiquid, but a massive national corporation with $100 million in profit sells for 15x or 20x earnings. It's safe, it's scalable, it's liquid. Here's the magic trick. A private equity firm buys 100 small plumbing companies at 4x earnings. They stitch them together into one giant company called U.S. Plumbing Corp. Instantly, without fixing a single pipe, that new company is valued at 15x earnings. They bought the cash flow for $4 and sold it to the stock market for $15. It is financial alchemy. They create value not by improving the service, but by changing the size of the entity. This is why they are desperate to buy every independent operator in town. Every clinic they buy is an instant 300% return on paper. You might be wondering, why my dentist? Why not a tech company? Because private equity loves inelastic demand. They want businesses that you cannot say no to. If the price of a Netflix subscription goes up, you can cancel it. But if your tooth hurts, you pay. If your dog is sick, you pay. If your toilet is overflowing, you pay. These are recession-proof businesses. The smart money calls this fragmented, high-margin, essential services. Dentistry is the perfect target. Historically, it was 80% independent owners. Today, dental service organizations, DSOs, backed by PE, are devouring the industry. They buy the practice, keep the dentist on as an employee for 3 years, and take control of the billing department. They know that you trust the doctor. They capitalize on that trust. They are monetizing the relationship you built over 20 years. Once the deal is signed, the operational improvements begin. This is corporate speak for squeezing the orange. I analyzed the playbook of a major veterinary roll-up. Here's what happens in the first 100 days. 1. Raise prices. Usually a 10 to 20% hike across the board immediately. 2. Cut staff. The receptionist who knew your name, gone. Replaced by a call center in another state. 3. Reduce inventory. They switch from the high-quality drugs Dr. Smith liked to the generic drugs the corporation gets a rebate on. 4. Quotas. This is the darkest part. The doctors are often put on a production bonus. They are incentivized to upsell you. Suddenly your dentist is telling you that you need deep cleaning and sealants and night guards every single visit. The care is no longer driven by medical necessity. It is driven by the quarterly EBITDA target of a fund in New York. But the extraction doesn't stop at higher prices. There is a financial bomb planted inside the company, the leveraged buyout, LBO. When a PE firm buys a company, they don't use their own money. They use a little bit of their money and a lot of debt. But here is the trick. They don't put the debt on their credit card. They put it on the company's credit card. Your local vet clinic is suddenly loaded with millions of dollars in loans that were used to buy it. The clinic now has to generate massive profits just to pay the interest on its own purchase price. This makes the business incredibly fragile. If a recession hits and revenue drops, the clinic can't pay the debt. We saw this with Toys R Us. It was a profitable company, but it was loaded with so much private equity debt that it couldn't survive a bad year. They kill the host to feed the parasite. Let's zoom in on the veterinary industry, because it is the canary in the coal mine. This sector has been virtually cornered. Mars Inc., yes, the candy bar company, owns VCA, Banfield, and Blue Pearl. They own thousands of clinics. Jab Holding, the coffee giant, owns National Veterinary Associates. Private equity owns nearly 50% of the specialty referral clinics in America. The result? Veterinary costs have outpaced inflation by 300% in the last decade. Pet owners are being forced to make heartbreaking decisions. Economic euthanasia, putting a pet down because you can't afford the treatment, is rising. But the toll on the veterinarians is even worse. Veterinarians have one of the highest suicide rates of any profession. Why? Because they got into the business to heal animals, and they are being forced by their corporate overlords to act like used car salesmen. The moral injury of denying care to a sick puppy because the owner can't pay the new corporate rate is destroying the soul of the profession. So how does the private equity firm make their final payout? They have a 5 to 7 year ticking clock. They need to exit. They have three options. 1. Sell to another, bigger private equity firm, pass the hot potato. 2. An IPO, sell the squeezed lemon to the public stock market. 3. A dividend recap. This is the nastiest move in finance. The PE firm forces the company to take out another massive loan and uses that loan to pay a special dividend to themselves. They get their money back instantly and leave the company with even more debt. If the company goes bankrupt later, who cares? They already got paid. When you see a rolled-up chain go public on the stock market, IPO, be very careful. You are often buying a company that has been stripped of its assets, loaded with debt, and maximized for short-term numbers. You are buying the carcass after the feast. There is a macro layer to this. Where is all this money coming from? It's coming from shadow banking. Pension funds, endowments, and insurance companies are desperate for yield. They can't get 7% from bonds anymore, so they give trillions to Blackstone and Apollo. This creates a dangerous loop. Your pension fund, public money, gives money to private equity, smart money, to buy your local dentist, Main Street, and raise prices on you, the consumer. You are effectively financing your own inflation. The dry powder, the unspent cash held by PE, is currently over $2.5 trillion. This means the buying spree isn't over, it is just beginning. They are moving into HVAC, car washes, funeral homes, and even single-family housing. Nothing is safe from the roll-up. Let's summarize the investigation. The inflation you feel in services isn't just the economy. It is a transfer of wealth from the consumer to the financial engineer. The smart money playbook requires you to be vigilant. 1. Identify the roll-up. Ask your provider, is this practice independently owned? If the answer is vague, run. Look for the independent owner-operator. They are the only ones with the incentive to treat you well. 2. Invest in the aggregators. If you can't beat them, join them. Stocks like KKR, Blackstone, BX, and Apollo, APO, are the ones collecting the rent on the economy. They are the landlords of America. 3. If you own a small business, do not sell to the first bidder. Know the value of what you built. You are the target. Make them pay the 15x multiple, not the 4x multiple. The storefronts look the same, but the owners have changed. Start reading the fine print. This is the smart money wisdoms. The future belongs to the owners.